stock, crypto, credit moves. Good evening, YouTube. We're back for another video. I want to discuss Biora Therapeutics, which is traded on the NASDAQ in the stock market and is actually a cancer company. So Biora Therapeutics engages in provisions of molecular and specialized diagnosis to clinicians. It includes the parent carrier tests, innate prenatal screens, recover hereditary cancer tests, and research of prenatal cancer. So this is actually a company. It before it was actually PROG, PROG, but recently it merged to Biora Therapeutics. So it's just actually a company that I hold a substantial amount of shares, and I bought this stock when it was like $1.75, and so it's actually fell against me. But I just wanted to display a strategy that you can still earn money on stocks that have actually fell against you in a bear market. So no one knows when these stocks will return. But for instance, I paid $1.70, so I'm down about 50% on this stock, and I still can make money if I write cover calls against the position that I have. So I have 10,000 shares. So in order to write a cover call, you need to have 100 shares. So if you have 10,000 shares of a company, you can write 100 cover calls. And that's what I did today, because the price of Biora Therapeutics has been hanging around this 83, 84-cent mark. And what I did was I wanted to make some income while I'm waiting. So let me go ahead and put up the example of what I did earlier. So I'm not too concerned about losing this stock, but I want to lose it at the stock price that's above what I paid. So if I paid $167 and it's down 50%, I set my cover call at $2. So if it falls lower than the 83 cents, my cover call is going to become profitable. So cover calls is a bearish strategy. It's a good strategy for a stock that's falling or a stock that's trading sideways, but you're still able to make income. So I actually wrote 100 contracts, and as you see, I collected a credit of $1,500. And when you write cover calls, those funds go into your account immediately. So you could take it out, or you can just buy other stocks, or you can just wait till the trade is completed. So it's actually funds that you can actually use for whatever you want. But your stocks are going to be tied into the trade until it's over. So I have a January 2023. I'm selling 100 contracts on Biora for a strike price of 2. So if before January, before January 2023, as long as this stock stays below $2, I'm able to keep all my shares, and I'm keeping the $1,500 premium that I collected. If it runs past $2, then I will lose my shares, but I still would get $2 per share, and I would keep the $1,500. So cover call is a conservative bearish strategy that you can use on if you have a substantial amount of stocks that you're holding. Not necessarily substantial, but you need to have 100 shares of a company in order to sell a cover call. So I'm going to start focusing a little bit more on the calls, a little bit more. I know I've focused a lot on a lot of crypto investments, but I also am involved in the stock market as well. So I'm just showing you an example today of how I collected $1,500. You can do this on stocks that you're holding for the long term if you have 100 shares or more. So it's just something extra that you can do instead of just holding. The only thing I would point out, you want to make sure that you set your strike price that you're willing to lose your stock above what you paid for it. Because if not, you're going to be taking losses. So if I paid $1.50 for these stocks, as long as I put my strike price above, I'm going to get 50 cents per share, and I'm going to lose it at $2. Now, if it runs up to $5, it's not going to matter. I'm still going to get $2. So that's the downside to selling calls, is you're limiting your upside. But it's definitely a good way to earn some money when the market is down. It's a bearish strategy. So I'll actually discuss a few more bearish strategies, but this is my number one bread and butter strategy when the stock market is falling apart. You still can make money whether the stock market goes up or down. A lot of investors don't know that. But with the cover call, you have a 66% chance of winning. You win if this stock trades sideways. You win because you're going to keep this premium. And the only way you lose is if it runs over the strike price that you selected. But you still are going to keep the premium. You just will lose your shares less than what you would lose your shares at the strike price that you selected. So that's pretty much it on the cover call. It's a very simple strategy. You have to just know what your average is in your position. You can set it above where you actually paid, and you're going to profit on the premium that you collect, and you're going to profit because your average is less than what you're losing it at. And the downside would be if it runs over your strike price, you're not going to keep this. So I hope that makes a lot of sense, guys, but I collected $1,500 today in a bear market, and I'll start doing a little bit more examples of calls. I'm not your financial advisor. I'm just a guy on YouTube showing you how I'm creating that cash flow. If you like this content, subscribe, comment. Until next time, let's keep that cash flow coming in.